you know that feeling, right? You need to understand something complex, maybe a new field for work, or just something you're curious about, and bam, you're just buried under information. Reports, articles, jargon everywhere. It's overwhelming. You just wish someone could cut through it all and tell you what actually matters. Well, that's exactly what we're doing here today on the Deep Dive. We're slicing through the noise to look at two really important connected worlds in UK finance. First, the specialized area of financial services regulatory compliance. Will look closely at a leading consultancy there. And second, the big changes the Financial Conduct Authority, the FCA, just made to mortgage rules. Our sources are the real deal, direct, factual stuff. It gives us a pretty unique view on how businesses handle these complex rules and how those rules are being shaped for you.
Exactly. And look, this stuff matters, even if finance isn't your day job. Seriously. These rules and the firms helping companies follow them, they're like the invisible scaffolding for, well, consumer protection, market stability, and how you interact with banks and lenders every day, especially for huge things like getting a mortgage. We're going to unpack some key ideas, and hopefully you'll have a few aha moments about what's going on behind the scenes.
Okay, let's start with that first world. This company, Compliance Consultant. The name says it all, really. But they're described as the UK's leading financial services regulatory compliance and FCA authorisation consultancy. That's quite a statement. What does that actually mean day to day? What problem are they solving?
Right. So Compliance Consultant, and they operate as a trading style of UK Compliance Consultant Limited. That's the formal bit. Their whole stated aim is to improve our client's condition. And they're very specific about this. It's not just about the price on the invoice. They talk about providing value that exceeds the cost involved.
Value versus cost. Okay, tell me more about that distinction.
Well, they argue price is just the fee, right? But cost includes everything, the long-term benefits, avoiding fines, saving management time, maybe avoiding some major disruption if you get compliance wrong. So for them, real value is that upfront investment, stopping much bigger, much more expensive problems later on. It's about preventing those costly mistakes.
That's a really interesting way to frame it. It makes you think differently about paying for expertise. So they're not just ticking boxes with generic stuff. You mentioned their services are bespoke, not the stock or off-the-shelf kind. What's a core service that really shows this bespoke approach?
Yeah, definitely bespoke. A prime example is getting firms authorized by the regulators, the FCA and the PRA. That's the Financial Conduct Authority and the Prudential Regulation Authority. Getting their approval isn't just paperwork. Compliance Consultant dives deep into the business, its strategy, its risks. They help turn a standard business plan into what they call a robust regulatory business plan.
Using the right words and phrases the regulator understands.
Precisely. It's about translating the business vision into regulatory language. They say, without that solid regulator-friendly plan, you'll likely fail the authorization process. It's foundational. The FCA watches how firms behave, protecting you, while the PRA keeps an eye on the stability of the bigger players.
Okay, so they help get the business set up correctly from the very start, speaking the regulator's language. That makes sense. But what about after authorization? Compliance isn't a one-off thing, is it?
Not at all. It's constant. That's where their ongoing support is key. They do things like compliance benchmark audits and projects. Basically, they check a firm's systems against the latest rules and, importantly, best practice.
So like a health check for compliance.
Exactly. Think about all the rules. Governance, terms of business, compliance manuals, those crucial AML KYC checks.
Anti-money laundering and know your customer.
Yes, making sure money isn't being laundered and you know who you're dealing with. They assess everything, right through to outsourcing policies. They score it, compare it, test it. It's vital for keeping a firm successful, compliant, and profitable.
And handling complaints, too.
Yes, they offer regulated complaints assessment and management. They can provide an independent review of complaints, check the files, and figure out the right response, including any redress or compensation if it's needed. They also do suitability file checks, making sure financial advice given was actually suitable, scoring it like the FCA would.
It sounds like a continuous loop of checking and updating. Given how fast regulations change, that proactive element must be critical. What about training?
Absolutely vital. Their training solutions are a big part of it. They have a whole range of courses, including really key ones like SMCR.
Yes, the senior managers and certification regime that holds individuals accountable, right?
That's the one. Huge implications for senior staff. And interestingly, Compliance Consultant really emphasizes the value of face-to-face training, suggesting it embeds the knowledge better than just clicking through online modules.
That suggests a deeper commitment to culture change, not just ticking a box.
I think so. And it ties into their proactive compliance advice. They're constantly scanning the horizon for regulatory changes, figuring out the impact, and guiding firms on how to adapt. It reinforces that customized compliance solutions idea: analyze the specific firm, find the gaps, build a tailored plan, no one-size-fits-all.
You get a real sense of how deep this goes. Are there any areas they cover that might surprise people? Something a bit niche, maybe?
Well, it shows their adaptability. They specifically mention helping with cryptocurrency registration for anti-money laundering. That's a fast-moving, complex area covering everything from crypto ATMs to brokers.
Wow, okay.
And another one is funeral plans authorization. Again, quite specific, requires specialist knowledge. It shows they can apply those core compliance principles to almost any regulated financial activity, new or old.
That breadth really speaks to their experience. How long have they been doing this?
They've been operating since the year 2000, so over 2 decades. They mentioned helping everyone from one-man bands through to banks get set up with FCA approval. That's a lot of regulatory evolution they've seen firsthand.
Clearly deep experts. And just to reiterate for anyone interested, Compliance Consultant, this leading UK consultancy, emphasizes bespoke solutions and value over price. You can reach them on 0800-689-0190. They're also known as the home of the compliance doctor and have a newsletter, The Compliance Compass. Okay, so firms like Compliance Consultant are crucial for navigating the rules as they are. But as we said, the rules don't stand still. Let's shift focus now to the regulators themselves, specifically the FCA and the significant changes to UK mortgage rules. The FCA calls them the first steps in their mortgage rule review. What's the background here? Why now?
Well, there's a bit of context. After the 2008 crisis, mortgage rules tightened up a lot, improving standards. Then more recently, we have the Consumer Duty launch, which significantly raised the bar for protecting consumers across the board. Now the FCA seems to be looking at how to introduce a bit more flexibility back into the mortgage market, aiming to make things smoother for lenders and borrowers. But, and this is key, while still making sure firms deliver good outcomes for consumers under the duty. It's a balancing act.
Right. And for you, the person with a mortgage or looking to get one, what does the FCA want these changes to achieve? They've said they want to make it easier, faster, and cheaper for you to do 3 main things. 1, talk to your lender about your needs. 2, reduce your mortgage term if you want to pay it off quicker. And 3, remortgage, potentially with a new lender.
Yeah, those are the headline goals. But a really important point is that these rule changes are mostly permissive.
Permissive,
Meaning firms can use these new flexibilities, but they don't have to. So just because the rule changes, it doesn't guarantee every lender will immediately change how they operate. How quickly you see the benefits might vary.
Got it. Okay, let's tackle the first big change. Mortgage advice and this interaction trigger being removed. This sounds quite fundamental. What did the trigger do and what happens now it's gone?
Okay, so previously, almost any meaningful conversation, any interactive chat you had with a lender or broker about mortgage options could legally trigger the requirement for them to give you formal, regulated advice, including a full suitability assessment.
Which takes time and effort, I imagine.
Exactly. So the idea now is that firms can have easier interactions, maybe discussing generic product features or how the process works without automatically being forced down the full advice route. But, and this is a really critical safeguard they've kept, if you have that easier chat and then decide you want to go ahead without advice, making it an execution-only sale.
Meaning you make the choice yourself.
Yes. You have to make a positive election.
Yeah.
You have to actively confirm that you understand you're giving up the protections that come with a formal suitability assessment, and you still want to proceed. The responsibility shifts more to you at that point.
Okay. I can see how that might streamline things. But you mentioned different reactions. Lenders liked it, but mortgage intermediaries, brokers, were less keen.
That's right. The documents show lenders were generally supportive. It simplifies conversations for them. But intermediaries raised concerns, partly about potential loss of revenue if fewer people take formal advice, but also about the risk.
The risk that vulnerable consumers, or maybe just people less confident with finance, might end up making complex choices without proper guidance.
Exactly that concern.
Yeah.
How does the SCA square this circle? Well, their view is that allowing easier initial conversations might actually make it less likely someone gets an unsuitable mortgage on an execution-only basis.
How so?
Their reasoning is it facilitates shopping around more easily. You can gather basic information without triggering full advice each time. And, they argue, these more natural conversations give firms a better chance to identify customers who may have characteristics of vulnerability and provide appropriate support. Plus, Crucially, the staff handling these execution-only sales still need that level 3 qualification. These aren't untrained call center staff. They have a solid level of financial services knowledge, often equivalent to diploma level.
Okay, that qualification point is important context. Let's move to the second change. Affordability assessments when you want to reduce your mortgage term. They're removing the need for a full assessment.
Yes, that's the change. If you want to shorten your mortgage term, maybe pay it off in 15 years instead of 25, lenders won't necessarily have to do the full, in-depth affordability calculation they do for a new mortgage.
And the benefit for the homeowner.
The main goal, according to the FCA, is it should reduce the total cost of borrowing. Less interest paid over the shorter term. Seems logical.
Are there still checks, though? Or is it free-for-all?
Oh no, definitely not a free-for-all. The safeguard is that the FCA still expect firms to consider affordability in line with their responsible lending policy and the duty, so lenders still need to be sensible and act responsibly. Some groups did ask how firms could be sure without a full assessment, but the FCA felt the existing responsible lending rules and the overarching consumer duty are strong enough safeguards here. They didn't see evidence of major problems with how this already happens sometimes.
Right, relying on the existing framework and the duty. Okay, third change. Remortgaging and the Modified Affordability Assessment, the MAA, it's being broadened. How does this help if you want to switch lenders?
This one's quite interesting for competition. The MAA is basically a slightly less stringent affordability check. Previously, using it to switch to a new lender was quite restricted. Now the rules allow the MAA to be used for a new mortgage contract with a new lender, provided that new mortgage is more affordable than either a customer's current mortgage or a new mortgage product that is available to that customer from their current lender.
So if switching saves you money compared to staying put or taking a new deal with your current lender, the new lender might be able to use this simpler check.
That's the idea. The FCA hopes this will encourage innovation and enable further competition by making it potentially easier for borrowers to move lenders for a better deal.
But again, potential friction. Did everyone think lenders would actually use this new flexibility?
Good question. There were doubts raised. Some respondents felt lenders might be hesitant due to potential risks, like credit risk, or just the challenge of applying it consistently.
So lenders might just stick to the full assessment anyway?
They might. The FCA acknowledges this by stressing it's a permissive rule. Lenders absolutely can still complete a full affordability assessment if they feel this is necessary. And they'll still use credit checks and their usual underwriting. The flexibility is there if lenders want to use it, perhaps for less complex cases, but they aren't being forced to take risks they're uncomfortable with. We'll have to see how the market responds.
Okay, one last bit of tidying up from the FCA. They're retiring two pieces of guidance, FG 107 and FG 242. What were these about?
Right, just clearing out some older documents. FG 1387 was guidance on dealing fairly with interest-only mortgage customers. Very relevant when many of those loans were maturing. FG 242 was more recent, about supporting borrowers hit by the rising cost of living.
Those sound pretty important. Why retire them?
The FCA's view is they've served their purpose, and crucially, the principles are now effectively covered by the comprehensive consumer duty. The duty provides the up-to-date standards. So rather than specific guidance, firms now look to the broader principles of the duty. However, they are adding a specific new rule to reinforce protection. Firms must deal fairly with customers whose mortgage terms have expired and can't pursue repossession unless all other reasonable attempts to resolve the position have failed.
So the duty provides the overarching framework, and they've added a clear rule on expired terms and repossession.
Exactly. It consolidates things under the new duty framework while maintaining key protections.
Okay, let's try and pull these threads together. On one side, we have this intricate world of financial compliance, where expert firms like Compliance Consultant provide essential bespoke support, helping businesses navigate incredibly complex rules, ensuring they're built on solid foundations and staying up to date.
Yes, offering that deep expertise and aiming for value that goes beyond just the price tag, covering everything from initial authorization to ongoing training like SMCR and adapting to new areas like crypto.
And on the other side, we have the regulators like the FCA constantly tweaking the rules like these recent mortgage changes, trying to find that sweet spot between flexibility, market competition, and making sure you, the consumer, are properly protected.
And the key takeaway for you listening is probably that these changes, while they sound technical, are genuinely intended to give you more control and flexibility, particularly with mortgages, making it easier to talk to lenders, pay off your loan faster, or switch providers. But, understanding the details, like that positive election for going without advice or knowing these rules are often permissive for lenders, that's still really important. It does put a bit more onus on you to be informed.
That really leads to a final thought, doesn't it? As technology makes interacting with financial services easier, maybe faster, and as regulations try to give you more choices and flexibility, how much responsibility ultimately lands on your shoulders to navigate it all effectively? And what kind of new tools or support might pop up to help bridge any gaps in understanding? Perhaps the real aha moment is realizing that staying informed yourself in this ever-changing landscape is becoming more crucial than ever. Think about what part of this discussion sparked your interest the most. Maybe the role of compliance consultants or the nuances of the new mortgage rules, and perhaps use that as a springboard for your own learning.